The outlook for the global economy has deteriorated. Oil, copper and lumber are all telling us the next economic downturn is here. Oil, copper and lumber are all telling us the exact same thing, and it isn't good news for the global economy. When economic activity is booming, demand for commodities such as oil, copper and lumber goes up, and that generally causes prices to rise. But when economic activity is slowing down, demand for such commodities falls, and that generally causes prices to decline. In recent weeks, we have witnessed a decline in commodity prices unlike anything that we have witnessed in years, and many are concerned that this is a very clear indication that hard times are ahead for the global economy. Let's talk about oil first. The price of oil peaked in early October, but since that time it has fallen more than 25%. And the IEA is warning of relatively weak demand out of Asia and Europe. The International Energy Agency said on Wednesday that while U.S. demand for oil has been very robust, demand in Europe and developed Asian countries continues to be relatively weak. The IEA also warned of a slowdown in demand in developing nations such as India, Brazil and Argentina caused by high oil prices, weak currencies and deteriorating economic activity. The outlook for the global economy has deteriorated, the IEA wrote. Meanwhile, the price of copper has been declining for quite some time now. The price of copper also fell substantially just before the last recession, and many analysts are pointing out that copper is now waving a red flag once again. The message of weakening demand on the oil front was reinforced by the falling price of copper. The base metal is often referred to as copper on its presumed ability to forecast the peaks and troughs of business cycles, since it is used in different areas of the economy such as homes, factories and electricity generation. Copper has served as a leading indicator of both recessions and economic booms. The price of lumber is a third witness that indicates that big trouble is looming. Last month, lumber dropped more than 10%, and that was the biggest monthly drop that we have seen in more than 7 years. In October, prices for softwood lumber in the U.S. dropped 10.3%, the largest decline since May 2011, according to the Producer Price Index, (P) released by the Bureau of Labor Statistics. The Producer Price Index for softwood lumber has fallen 21.2% since setting the cycle an all-time high in June. If oil, copper and lumber are all telling us the same thing simultaneously, don't you think that we should be listening? At this point, even Bloomberg is admitting that the global economy is heading toward a generalized slowdown. These developments suggest the synchronized growth that the global economy has enjoyed in recent years is likely to be replaced by a generalized slowdown. Just take a look at the data out of Japan and Germany this week, which showed the world's third and fourth largest economies contracted in the third quarter. How many signs is it going to take before people start understanding what is happening? Wells Fargo just notified about 1,000 employees that they will be laid off. Job losses are starting to mount, and it is likely that we will start to see these sorts of news stories on an almost daily basis now. And as the shaking on Wall Street accelerates, we are going to see more financial firms get into trouble. In fact, we just witnessed the total collapse of optionslurs.com. The following comes from a notice that they sent to investors informing them that they lost all their money and that the firm is being liquidated. I am writing to give you an update on the situation here with your account. We have spent the week unwinding our short natural gas call position as expediently as possible. Today, which was to be the final day of liquidation, the market flared as prices appear to have been caught in a short squeeze. The speed at which it took place is truly beyond anything I have seen in my career. It overran our risk control systems and left us at the mercy of the market. In short, it was a rogue wave and it overwhelmed us. Unfortunately, this has resulted in a catastrophic loss. Our clearing firm, FC Stone, now requires us to liquidate all positions. We hope to have this done today. If not, it will be completed tomorrow. Your account could potentially be facing a debit balance as of tomorrow. Optionsellers.com will be processing fee credits over the course of the coming days to help alleviate debit balances. What these will be determined after all positions are cleared. This has in effect crippled the firm. At this point, our brokers at FC Stone have been assisting us in liquidation. Our offices will remain open, and we will all still be here to answer your questions and process account closings. We will do everything in our power to ease what discomfort we can. I am truly sorry this has happened. I will be updating you again via memo in 24 hours. Regards, those investors are among the first to be completely wiped out, but they certainly won't be the last. The ironic thing is that Americans are less concerned about another crisis than they have been at any point since 2008, at a time when they should be more focused on getting prepared than ever. You know that it is really late in the game when even Jim Cramer of CNBC is saying that the US economy is really slowing down. A few of my readers wrote me after that article because they didn't like the fact that I had quoted Jim Cramer. But I don't think that they really got my point. I was not endorsing Jim Cramer as some sort of financial guru. Rather, I was pointing out that even mainstream media celebrities that were previously cheerleaders for the economy are now recognizing the reality of what we are facing. Global economic activity is slowing down, and things are shifting very rapidly now. The weather is already getting very cold, the mood of the nation is very dark, and it would only take a very small push to send us completely tumbling over the edge. Oil sends a crude warning. As with many Americans, I am on the road with the family making the traditional holiday rounds. Of course, my family is more the Griswolds than the Waltons. But even with all of the antics, comedy, and occasional drama, it is always an enjoyable time of the year. However, I did wake up from my tryptophan-induced coma long enough to pen a few thoughts on the crash in crude oil and the message it is sending. On Monday, I am publishing an article on the fallacy that falling energy prices are an economic boost. It isn't, and we dig into all the reasons why in that article. However, the short version is that oil prices are a reflection of supply and demand. Global demand has already been falling for the last several months, and oil prices are now waking up that reality. More importantly, falling oil prices are going to put the Fed in a very tough position in the next couple of months as the expected surge in inflationary pressures, in order to justify higher rates, once again fails to appear. The chart below shows break-even 5-year and 10-year inflation rates versus oil prices. Oil prices also tend to lead the broad economic cycle as well. The chart below is one of the broadest measures of economic activity and is comprised of leading economic indicators: Fed Regional Manufacturing Surveys, NFIB Small Business Survey, ISM, CFNA, and Chicago PMI. Since most of the economic data we look at is trailing, and subject to heavy negative revisions, the collapse in oil prices suggests that coming economic reports will likely be materially weaker than currently expected. Can I have a side of debt? But there is another enormous problem currently for the oil and gas sector currently at risk: the debt. For the last few years, oil companies have been taking of the extraordinarily low interest rate environment to leverage up to chase marginally productive drilling in high depletion rate shale wells. Since energy-related bonds make up about 15% of the high-yield index, and with a substantial number of corporate bonds on the verge of falling below BBB ratings in the months ahead, the potential impact of falling energy prices, a reduction in revenue, and higher borrowing costs is a potential double whammy to an important sector of the economy. Mark J. Grant recently made some interesting points on this issue. Moody's said the amount of U.S. corporate bonds outstanding, rated at its lowest investment grade level of BA, rose to a record $2.83 trillion in the third quarter, topping the $2.62 trillion in single A corporate bonds and the $629 billion in outstanding bonds rated A or higher. Within the BA group, the dollar amount of bonds rated BA3, Moody's lowest investment grade rating, ballooned by 140% from the fourth quarter of 2007 to a record $705 billion in 2018's third quarter. Here again, the Fed is not helping, as they are driving up borrowing costs for all of these companies, across the board. There is also a danger here to many insurance companies, as their credit rating could be downgraded if more of the bonds that they own are reclassified as junk. Here is another doom loop scenario that is playing itself out as yields rise and now gap out, in many credits, versus treasuries. BA3 grade corporate debt outstanding has now reached an unprecedented 56.8% of speculative grade, or junk, high-yield corporate bonds outstanding. By comparison, the ratio of outstanding BA3 rated bonds to high-yield bonds was 32.5% before the 2008 to 2009 financial crisis, 36.9% before the 2001 recession, and 22.2% before the 1990 to 1991 downturn. Startling figures, no doubt. Moody's stated, thus, from the perspective of dollar amounts outstanding, the U.S. investment-grade corporate bond market is now riskier than it was before each recession since 1981, and possibly all prior downturns through the late 1940s. Greater uncertainty surrounds the sustainability of corporate earnings growth has adversely affected the performance of medium and lower-grade bonds. Not since September 2016 has the long-term buy-industrial spread remained above 200 basis points on a recurring basis. The collapse in oil prices, which is a direct impact to revenue for oil and gas companies, is going to make already nervous lenders even more adverse to lending to the sector. Secondly, demands to shore up credit lines, increase loan covenants, provide additional collateral, or simply increase borrowing costs could have a materially negative impact on the sector as a whole. I warned you, but none of this should really be a surprise. As I wrote back in August, the rise in crude prices from the lows has also been primarily responsible for the uptick in both economic growth and inflationary readings. However, higher oil prices are also a double-edged sword, which also acts as an additional tax on consumers as well as corporate profit margins. The push above $70/barrels led to a massive surge in crude oil speculators chasing price, but also provides the fuel for a sharp reversal as well. For investors, it is also worth noting that crude oil positioning is also highly correlated to overall movements of the S&P 500 index and earnings growth. With crude traders currently extremely long, a reversal will likely coincide with both a reversal in the S&P 500 and oil prices being pushed back towards $55/barrels. While oil prices could certainly fall below $55/barrels for a variety of reasons, there is reasonable support around $50/55/barrels barring an economic recession. Since then, that prediction has become a disappointing reality. However, it is critically important that oil holds support at $50/barrels, otherwise, you are looking at oil prices near $40/barrels, substantially weaker economic data, and even lower stock market values. Oil prices are just another confirming factor that we have likely edged into a bear market, and downside risk continues to outweigh upside reward. Last week, we further reduced equity risk, further bringing exposures down to just 40% of our portfolios. On a rally to the 200 MA which fails, we will reduce risk more and add negative hedges to portfolios. Daily view: there is little good news to be had this week. The market broke recent lows and will now be looking to retest the lows of earlier this year. With the 50 MA sloping sharply lower and the 200 MA following suit, the backdrop of the market has turned decidedly bearish. More importantly, and also a negative, is the market is now consistently trading below the 200 MA. This should serve as a warning to investors to reduce equity exposure on rallies and remain hedged until these trends begin to reverse themselves. Action: after reducing exposure in portfolios previously, we reduced risk further this past week. Sell weak positions into any market strength on Monday. Weekly view as stated previously, since we prefer longer-term holding periods for our positions, we prefer to use weekly and monthly data to reduce the number of signals, but reveals the more important overall trends of the market. On a weekly basis, the market is now extremely oversold on both a relative strength basis, and prices are pushing 2 standard deviations below the 50-week moving average. As shown below, on a weekly basis, a sell signal has been registered for the second time this year, suggesting that investors reduce equity risk in portfolios. However, given the extreme oversold conditions of the market, look for a rally through the end of the year to make adjustments to overall risk exposures. Note that such reversions from prior overextensions are usually associated with more meaningful market events. However, as I noted on Tuesday at Real Pro, currently, the market is oversold and is set up for a short-term bounce. In the next few days, we will look to add a trading position to portfolios for a potential year-end rally. As we have stated previously, we are moving into the seasonally strong period of the year combined with the post-midterm election period, which has historically equated to a positive push in the market. However, nothing is guaranteed, so the recent changes to portfolios to raise cash, shore up risk, shorten durations, and increase credit quality all remain prudent actions. Most importantly, while the market will indeed garner a rally over the next couple of months, such will not change the fact that we are in the midst of a substantially more important topping process. The chart below lays out the potential range for a bounce before a continuation of the current decline ensues. I want to caution you that by the time longer-term sell signals are issued, the market tends to be more extremely oversold and due for a reflexive bounce. It is still highly advised that bounces be used to reduce equity exposure until there is a definitive improvement in the overall technical backdrop of the market. Action: sell weak positions into any strength next week. Monthly view. Moving back to a monthly view, signals become much slower and much more important. However, signals are only valid on the first trading day of each month. Therefore, while the markets have registered the monthly signal as of this week, it will only be valid if the markets fail to rally enough to reverse it by the end of the month. Nonetheless, the deterioration in the markets is extremely concerning, and by slowing the signals down further to crosses a very long-term moving average, the risk to investors becomes much clearer. Action: reduce risk on rallies, as detailed above, and look to add hedges. As always, the messages being sent by the market are more than just concerning and suggests that actions be taken to reduce portfolio risk on rallies in the weeks ahead. I warned previously the Fed was likely to hike rates until something broke. But one thing is for sure. If something hasn't already broken, it will break soon if rates keep rising. That day may be much sooner than most expect. It continues to appear that day has come.